So turning to the markets, Drew, in your mind, what have been the driving factors that have gotten us here today?
Thanks for the question, Gordon. Really look forward to expounding on some of this for you and our audience. Essentially, heading into the new year, we were doing quite well from an economic point of view. The long-term average, or call it, 25-year average of GDP is 2.1%, and we were growing above that for many consecutive quarters. So entering in really strong footing from an economic point of view. And it really wasn't until early April that we saw some of the impacts of tariff policy really maybe throw a wrench into some of that progress. 30% effective tariff rates is what was estimated in early April. And as you can see, in 1900, we didn't even get that high. And back then, they used tariffs as a reasonable amount of income to generate for our nation. 30% is even higher than the Great Depression era, and it's multiples times higher than anything in recent memory. We do have a reduction in the expected tariff rates at about 15% as of the end of the quarter. And essentially, even that, as I alluded to, would be multiples times more than anything post-World War II. So we're really in kind of uncharted territory as to how the tariff effects will ripple through the economy. So we're definitely waiting with bated breath on that. And actually, if you peel back the onion a little bit and you look at the quarterly GDP numbers, we can see the effects of tariff policy play out right in front of us. The first quarter GDP numbers were negative 0.5%, which was the first negative quarter in years. A lot of that, though, came from the net import-export calculation, which dragged it down. Anyone and their brother who owned a business and relied on imports imported huge amounts in that first quarter, which, of course, again, dragged down the total calculation. We should get quarter two numbers for GDP in the not too distant future, and we'll be very keen on looking at the import situation, but then also consumption, which looked a little shaky in the first quarter too. And that would be something very important to key in on.
Everyone's always interested on what the Fed is up to. Drew, what's your take on where interest rates are going?
Well, Gordon, that is definitely true. And like real estate, it's location, location, location. Well, now it's what's the Fed doing? What's the Fed doing? What's the Fed doing? And really, no one knows at the end of the day. But there's a few clues I think we can gather. One is that we know interest rate movement will be volatile no matter which path it takes, up or down. The biggest reason for that, and really, as Alan alluded to before, the reason why the death of the 60-40 portfolio has occurred has been the change in interest rate direction. A 40-year trend in interest rates declining was broken a couple of years ago, and it really looks like it will never resume. And that, I think, will lead to interest rate volatility as a given. Now, the Fed and the market have basically telegraphed a decline in rates upcoming, but no one knows when that'll happen. Fortunately, inflation has fallen to a point where I think it gives the Fed some cover if they do want to move with interest rate cuts, especially if the labor market or the economy starts to falter.
Drew, you had mentioned tariffs earlier. What else should we be aware of from a governmental sense that might affect the markets?
Yeah, Gordon, that's really a great question. Tariffs have certainly been something introduced by the government that has caused a big curveball this year. And while it's more of a strategic risk, something that should be on everyone's minds is where the U.S. fiscal situation stands. The 2025 budget is $7 trillion in spending. We're bringing in only $5 trillion or so in income. That's a $2 trillion deficit that we have to fund through debt. Of course, we are issuing our debt at higher interest rates than the reasonable past. And that's leading to almost $1 trillion in annual interest expense just to service our existing debt, not to mention anything coming down the pike in the future. And we're seeing some pretty clear market commentary about this. The biggest one is that long-term interest rates keep going up. And at the end of the day, that's the market demanding a higher rate of interest from us to account for our slightly worse standing in the marketplace as a borrower. The other very clear commentary is that of gold. Gold tends to do well in inflationary periods, and then also periods where there's a lot of questions about the current monetary or fiscal situation going on. Gold is seen as an alternative currency. It's seen as an alternative path in the financial markets than the current existing solution. So that is definitely at play right now, and the government is responsible for that.
So you had mentioned gold as an alternative currency, but what about our own dollar?
Yeah, that's a great question. The dollar is not dead, of course, Gordon. But the reason why gold is doing so well is it's on the margin when questions are introduced about our position in the global trade environment, our position in the global kind of defense posture. The dollar tends to take a fall when some of these questions are, when they get a little louder. I think at the end of the day, we have to be really mindful of this and also look at it as an opportunity. When the dollar falls, international markets tend to outperform domestic. And US markets this year, up until mid May, were negative. And at the same time, the international markets were pretty positive. So that type of a juxtaposition doesn't happen all that often. And it's something we should take note of.
So, with all this being said, would you say that this is a problem solely for the US? Or what are other countries experiencing?
Yeah, that's an interesting question, Gordon. I think that, yes, deficits are certainly a global problem, but it's being felt, I think, pretty acutely here in the US. And with the news of the OBA bill passing 2 weekends ago, it's probably only going to come more into the forefront. Internationally, though, is having a much different experience as it relates to stocks this year, primarily because the dollar has been falling quite a bit as the year has progressed. And as we know, that leads to international stock market outperformance relative to the US. It wasn't until the recovery in tariff expectations in May that we actually saw the US domestic stock markets pull out of the hole and get into positive territory. So for much of the year, international markets were high, US markets were in the negative. And a big part of that is the decline in the dollar.
So, Drew, what I'm hearing is there's a lot of volatility out there. So, what is the Greenwell team doing to combat this?
Thanks, Gordon. And I think that that's a really great question because we know that there will be higher than average volatility ahead of us. You don't just break a 40-year trend in interest rates without big ripple effects. You don't have huge inflation for the first time in 40 years and not have ripple effects. So we know the volatility will be here. We just don't know exactly where it might stem from on a day-to-day basis. So as a result of that, we have really looked to diversification to solve these unknowns for us. And we have diversified away in a big way from fixed income as the primary offset to stock volatility. We have introduced alternative investments, which could be gold, it could be managed future strategies, it could be private investments. But what we know is that diversification needs to play a huge role in our clients' portfolios. This year has been the biggest commercial for that.
Drew, thank you for your valuable insights. I know it's important for our clients and our community to really know what's happening at this point in here.
Yeah, it's really my pleasure and an honor to be able to share with our broader community. We really look forward to doing these. If you have any questions on anything you've heard or would like more information, please don't hesitate to reach out to anyone on the team. And until next time, thank you so much.